Hey everybody, welcome back to No Genius. Today I just wanted to get a little bit deeper into mortgage note investing, and answer some of the questions that I get when I talk to people about note investing. It's a very new concept for a lot of people, even people who have been in real estate for decades. They're not very familiar with it, and so I put together a few slides just to kind of discuss what mortgage note investing is all about, and kind of it says a deeper look, but it's kind of just a surface level a synopsis of where mortgage note investing came from and what it's all about. So I'm going to go over a few slides. One is a quick history of notes. What is a mortgage note? What kinds of notes you can buy? What makes a good note? What makes a note a good opportunity to buy? How much you need to start? What the risks are? I get that question a lot. It sounds too good to be true. We're going to talk about that. And then the benefits of note investing. So this will be pretty quick. But I just wanted to kind of address some of the more general questions that I get when I talk about note investing. So, quick history of notes. We all know that the American dream is to, be able to buy a home to support your family and build generational wealth and all that. Prior to 1934, though, home buying required a 50% down payment and only gave loans of 5 years, which was not very, conducive to your average American being able to purchase a home. So in 1934, the Federal Housing Administration came in and they made it so that you could buy a home for 3.5% down and extend loan terms up to 30 years. Nowadays, we're familiar with the 30-year mortgage. Sometimes it's 20 years, but regardless, you can stretch it out over a longer term to make the payments more affordable. And that led to an explosion of home ownership. That's what it's all about. But unfortunately for the banks, they started to run out of money. They were lending so much that they couldn't keep up with the demand, and they started to run out of money. So 1938 comes around and Fannie Mae is established. I think most of us have heard of Fannie Mae before, but Fannie Mae is established to buy mortgages from the banks and guarantee payment on them, right? So Fannie Mae creates the secondary mortgage market, which allows the banks to sell pools of mortgages and recoup lump sums at one time. But the issue with that, I guess it wasn't an issue for them, but they only sold these pools of mortgages to other banks, financial institutions, or wealthy individuals. So your average person like you and me, we had no access to this stuff. If you didn't have millions of dollars or whatever that amounted to back in the 1930s, you weren't getting any of these. You weren't touching them, right? So that goes on for about 70 years or so. Everything is all good, everything makes sense. The lending terms get kind of crazy here and there. But in 2007, 2008, the housing market crashes, right? And the foreclosure rate spikes from 5% to 25%. So that's one in every four houses in default. Obviously, the banks cannot keep up with that foreclosure rate. They're losing money. They're not earning money on the loans that they gave out. And so they start selling off mortgages to hedge funds at discounts, right? So if a mortgage was $50,000, they'd sell it off at 40 or 30 or whatever they could get, depending on how bad it was. Then these hedge funds started selling to smaller funds and brokerages, which then sell to individual investors like myself. So I say all that to say the reason that a lot of people have never heard of mortgage note investing is because the mortgage market has really been open to the average individual, the average investor for only about 15 years. So it's relatively new when you consider the scope of real estate investing and what's possible. But it's available to us now to take advantage of, and that is what I fully intend to do. So, what is a note? Flat out, a note is an IOU. It's a promise to pay on specific terms. Notes are typically tied to collateral, so most of us have had a car note at some point. Maybe some of us still do. Your mortgage is a note that's tied to your home. But essentially, the purpose of that collateral is failure to pay on your note, on your agreement to pay, results in forfeiture of that asset. So a repo, foreclosure, whatever the case may be. Notes generate monthly cash flow for the lenders, which is typically the bank, right? Which is great. It's passive cash flow is coming in every month at a certain interest rate. But some eventually prefer to receive payments in a lump sum. Kind of like I was saying in the last slide, where the bank started to run out of money. They were selling these notes to these hedge funds so that they could recoup a larger sum and start giving out more loans, right? So that's kind of how the note market works, right? They're collecting on cash flow for a while, then like, okay, this cash flow has been great, but I'm ready to go reinvest, ready to go buy something else. So I want a lump sum. I'm going to sell this cash flow to get more money up front. So there's different kinds of notes you can buy. You can buy notes on kind of anything. Single families are very popular, of course, single family homes, but you can buy notes on duplexes or, multifamily. You can buy notes on commercial properties. So if you want to buy a note on even, not even just a single store, but one of those kind of mall complexes, I've seen notes available for those. You can buy notes on mobile homes. You can buy notes on apartment complexes. There's a lot of land notes going around as well. So there's kind of diversity in what you want to invest in. Of course, they all come with their own risks. They all come with their own price ranges. But there's a variety of kinds of notes that you can buy. And then there's really two main categories for notes. You have your performers, where your borrowers are making regular monthly payments according to the agreed upon terms, right? They're paying $1,000 a month for the next 20 years in order to, complete the purchase of their home. It's priced according to or rather, when you're buying a performing note, it's priced according to the UPB. That's the unpaid principal balance. So whatever is left that the borrower still has to pay on, is priced on the term length. So you're going to pay probably more for a note that has 10 years left than you would on a note that has 5 years left because you'll be collecting more interest over that time frame, right? It's dependent upon your borrower history. So even though it's performing, maybe this person isn't paying their mortgage every month. Maybe they miss a month here or there. Maybe they miss 2 months and then they catch up all at once. That has an effect on how much a performing note is priced. But the purpose of buying performing notes is that they generate years of cash flow, right? So you buy a performer, somebody still has 10, 15, 20 years left on this note. So for the next 10, 15, 20 years, assuming they're paying, you're collecting passive cash flow, right? It's a great strategy, obviously. If you can stack them and, build that passive cash flow up to support your lifestyle. But yeah, ideal for passive investors, ideal for retirement accounts. Some people will buy a note within their self-directed retirement account because again, it is passive cash flow. It's just going to keep stacking and stacking and stacking over years. They can't touch that money anyway. And it's tied to collateral. So there's a security aspect of it that makes it really appealing for someone who wants to put that in their retirement account. The other kind is a non-performing note, right? So the borrowers are several months, maybe several years behind on payments and at risk of foreclosure. People would say, well, why would you want to buy that? You're not making any money. But you can buy a non-performing loan at a heavy discount. So, you take $100,000 note that hasn't been paid on in 2 years, you might be able to get it for 50 or 40K because the person who owns it is not making any money on it. All right. Now, what would you do with it after you buy that non-performer? You can try to get it performing again, or you can go into the foreclosure process, claim the collateral, and sell or keep the property. But the purpose of non-performing notes typically is that they're going to generate lump sum profits for you. So with the performers, you got cash flow trickling in every month, right? With non-performers, you're trying to hit home runs. You're going for lump sums. So non-performers are typically more appealing for people who are used to fix and flips or wholesaling or development deals, people who are used to waiting a few months to get their large return, they're typically more attracted to non-performing notes. So what makes a good note? What makes a note a good opportunity? Because, every investment is not a great investment, right? Number one is the loan details. Again, how much money is left on this mortgage? What's the interest rate? Where is the property located? Is the borrower paying, taxes and insurance, or has that not been factored in yet? What's the borrower's payment history, right? All those things kind of factor into what makes a good note. Then you want to look at the property condition because remember, your mortgage is tied to the property. So you don't want to invest in a mortgage that's tied to a beat down property or, maybe they put up an old picture of the property and you go by and it actually burned down 2 months ago. I've heard stories like that. which you want to make sure that the property is in good condition. Just in case you have to claim it as collateral, you'll have the option to resell it, and somebody will actually want it, right? And you'll be able to get a good price for it. Your borrower history. So how consistently are they paying? Are they easy to get in contact with? Have the current loan owners had issues with them? That factors in as well, right? And then your surrounding neighborhood. You want to make sure that your property is in a good neighborhood or a decent neighborhood, somewhere that someone would want to live if you had to resell that property. So you don't want to see bars on the windows. You don't want to see, you know, cars with the tires stolen off or broken glass all over the place or whatever the case may be. You want to make sure that the property is in a decent neighborhood. Um, and then how much do you need to start? I mean, you don't necessarily need a whole lot. I've seen notes for as little as 5K. I've seen notes for millions, so there's a wide range depending on what you're looking for. Obviously, the more you pay for a note, the more the cash flow is going to be. You're not going to buy a $10,000 note and collect $1,000 a month. That's just not realistic. But you might be able to, buy $100,000 note and collect $1,000 a month. Each deal is different, but higher price equals more cash flow typically. Okay. The interest rate has an effect on that as well. So that's not the set in stone rule, but that's typically how it works. For the average person, the sweet spot is typically around 50K to 150K. It's not such an outrageous number that people don't have it. Again, some people have that in a savings account, some people have that in a retirement account, but it's accessible at some point for the majority of people, I would say. Um, but then those also offer a decent return. So anywhere from 400 bucks a month on the low end to 1,500, 1,800 on the high end. That kind of range is what you're looking at as far as your monthly cash flow. Then you can also consider investing with friends. One thing that you can do is pool your money, with some other people that you know who may have some money. Say a bunch of you, say 4 or 5 of you have $10,000 to invest. You can pool your money into a trust and go buy a note together, and then all of you, get broken off of that cash flow month to month. So even if you don't have the full amount by yourself, there's still a possibility that you can go ahead and invest and earn yourself some passive income. All right. So this is the biggest question I get. What are the risks of note investing, right? I talk about the benefits of it all the time. And people say, "Oh, it sounds too good to be true. Oh, if this is so great, why have I never heard of it before?" Most of the risk that you're going to encounter is going to happen before you buy. Okay. And a lot of it is addressed in the due diligence period. So you're going to go through a whole due diligence period for a week or two and make sure that this is a good opportunity before you purchase it, right? But number one, of course, is like I said, the quality of the property in the neighborhood, right? If you're not buying it right, if you're not making sure that the property is in a good area and is in decent condition, that can bite you on the back end should you have to foreclose, right? Number two is the quality of borrower. So if they're not paying, if they're inconsistent, if they're difficult to deal with, that can cause problems with you for your note. Because we want this to be a passive investment, right? We don't want to have to keep chasing down our borrower and, hey, you haven't paid this month. Hey, you've missed 2 months. Or, every time you reach out to them, they're cussing you out. You don't want to deal with that, right? The third thing is state foreclosure laws. Every state has different foreclosure laws. Every state takes a different length of time to foreclose, right? So you buy a note on a property in Texas, you can foreclose in 3 months or so, right? You buy a note on a property in New York, you could be waiting years for that foreclosure to go through. So state foreclosure laws make a difference. They do carry risk. You want to be careful about what notes you're investing in what states. Okay. But again, like I said, most of the risk is addressed prior to the purchase. The biggest risk after purchase is just borrower life events, right? Life happens, people lose jobs, people get hurt, people get divorced. There are different factors that can affect a borrower's ability to pay on your note. And there are remedies for that. We have different options as the note owner to kind of help them out of that situation and try to get things cash flowing again, whether you give them a loan modification, like, hey, we'll drop your payment, but we'll extend the term. So you're paying less for longer. You know, that's an option. Um, hey, it would cost me $3,000, $4,000 to foreclose on you. How about I give you that $4,000 and you sign the property over to me, right? No eviction, no foreclosure on your record. You know, so there are things that you can do outside of just straight up foreclosure, hey, get out, to kind of remedy these life events, right? But most of the risk again is before you buy. And then of course the benefits of note investing, right? No tenants, no repairs, straight cash flow, right? You are not a landlord, you're the bank. So nobody's calling you at 2 in the morning to fix their toilet. You don't have to go fix a roof or a blown water heater, right? You buy the mortgage and you're sitting back and collecting cash flow as long as your borrower is paying, right? Mortgage notes provide contractual income. So the stock market, your traditional real estate market, those things are market driven, right? There's a lot of outside factors that are out of our control that affect how your money, how you receive your money, how you get a return on your investments, right? With mortgage notes, you're buying a contract. So if that contract says this person owes $1,000 a month for the next 20 years, it doesn't matter what's going on in the world, right? Aliens could invade. You're still owed $1,000 a month for the next 20 years, or their property is at risk of being claimed as collateral, right? Mortgage notes provide multiple exit strategies, right? You could buy and hold them. You could sell partial note, right? So you could sell the next 5 years of payments on a 15-year note, right? To collect some cash up front. Again, you could claim the property as collateral and sell it or rent it out. There's a lot of different exit strategies that you can use. It gives you flexibility depending on what you're looking for, right? Again, investments secured by collateral. I've touched on that a few times. But the biggest thing is it's totally passive income, all right? Passive income is what we're after. Traditional real estate, and unless you have a property manager or someone else to handle that for you, it's not passive income. Yes, you're collecting rent money or whatever the case may be, but there's still work that you have to do to make sure that your property that you own is still being kept up to par, still being taken care of, right? If you don't desire to be a landlord, but you want to collect cash flow on real estate, this is the way to do it, right? So that's kind of a general overview of how notes work, where they come from, what they are. If you're interested in learning more about notes or potentially doing a deal, I'm always looking for people to partner with. I'm always looking to educate people on note investing because it really does have the potential to be life-changing, right? You can go ahead and visit our website, notegenius.com, note-genius.com. Send me an email, follow me on the socials. I'll continue to post content and educate and just give you an authentic view of my own journey through note investing. I plan on posting videos for, when I'm buying a new note, how it's going. When God forbid a deal goes bad, I'll show you guys that too. But I want to keep it real and authentic because I believe that note investing is a strategy that can serve a lot of people and help people get to the lifestyle that they desire. Right. So that's all I have for today. Be sure to like and subscribe and stay tuned for more content, and I'll see you guys soon.